Hey traders, this is Blake Morrow with Traders Summit. And we're going to be asking Jim Welsh from Macro Tides, what happens now? What happens now? We have Trump has taken the presidency, stocks have rallied, the dollar is coming unhinged actually as we speak. What's going to happen from here? So let's bring in Mr. Jim Welsh from Macro Tides. Jim, how are you?
I'm good, Blake. Hope you're doing well on this beautiful Friday.
It's a beautiful Friday, and boy, is it a crazy, crazy market.
Yeah,
What do you make of everything that we've seen this week? I mean, we're on the cusp of finding out if we have a Republican sweep.
yeah. Um, well, honestly, I'm kind of hoping that the Dems have the House just because I like some check on power. I think historically that has been proven repeatedly. Living in California, I've seen what one party rule, um, what happens. And I'd say on balance, there's a lot of bad with the good. So no, I think what happened this week, Blake, is because all the polls were indicating that this was incredibly close. And as the positions, I think, around that outcome built up, no one had a really good idea. So I think there was a lot of hedging, especially if you look like at the VIX. The VIX had been really elevated for the last 2 weeks or so. I think that's a reflection of the hedging of positions that were being taken, not just in equities, but I think in all the markets. So when you get an outside reaction to news that was, I'd say, fairly unexpected, I think that's what we've seen is just this explosion of volatility as hedges were covered. And then at the same time, another group of people, well, with that outcome, I'm going to put my money invested in this manner. And I think that combination is why we've seen, very large moves in a matter of hours in most of the markets. Typically, we'll see things obviously calm down as all the unwinding is done. People have gotten to a level of positioning based on the new premise. I just think you get a period of relaxment that's going to settle in here over the next week or two.
Well, I'm interested to see the charts that you have to show us what kind of lack of volatility we're going to have. I have a feeling
Yeah.
that it's going to be extremely volatile, especially as traders try to figure out what exactly a second term of President Trump is going to look like in the next 4 years. And we have a couple of months to kind of decipher that. So let's start off with some of the charts that you brought, Jim, and
Yeah.
let's talk about your first one, which is
Well,
this biggest
co-
post-election rally since 1896.
yeah. I mean, this puts numbers on what we all experienced. And again, it goes to a lot of factors coming together. And, I do think that this time around, we have a better idea of what a Trump presidency will be because this is the second go round. I think that might be helpful to Trump in the sense that he learned a lot during his first, administration that I think will be helpful to him. So at least I'd like to believe that. Hopefully, the level of acrimony goes down, although so far, the reaction that I've seen of people who were very, very disappointed in the election, Blake, I don't see almost any self-reflection. It was racism, it was sexism, Joe Biden should have dropped out. I mean, I'm not saying any of those reasons didn't play a role, but I don't see any Democrats saying, maybe our policies on the border had something to do with it, or lying to the American people about Joe Biden, his efficacy of remaining the president. So many issues, the border, obviously. So to me, I'm hopeful that the Democrats get through this emotional phase and then have a period of introspection to realize that this outcome was in part not just because of Donald Trump or Twitter or X, its role, but maybe it actually had to do with some of the things that they've been pushing and pushing. People just don't like the idea of of boys participating in girls' sports, going into girls' bathroom. It's like, wait a second, that doesn't jive,
Yeah.
So hopefully there's introspection within the Democratic Party, and they stop getting pulled to the left by the most progressive members of the Democratic Party and move towards the middle. I think if they do that, it will be very positive for them.
Well, we'll see. We're gonna see. I guess only time will tell there.
Yeah.
So obviously, we're seeing this big rally in the equity markets. And I guess the question I'm going to have to pass to you is, do you think it's sustainable?
Um, yes, I think in the very near term, you've got the end of the year approaching. That acts as, the fear of missing out, I think becomes a greater factor given the change what we've just seen. So I think you have to give the benefit of the doubt to the upside. As you noted before we started, it's hard to think of a reason why the market would go down. And this is a theme that I've talked, and you and I've talked about this a lot. You need a reason to sell to appear to get institutions that are long biased to actually cut back on buying or, oh my God, actually do some selling. It's very difficult in the very near term, Blake, I think, to come up with any significant reason. That doesn't mean the market couldn't have a 3% or, maybe a 5% pullback just because of the nature of this move. But anything bigger than that is going to take something more than just, a normal correction after a big, sharp move in a very short period of time.
Sure. Yeah, absolutely. All right. Let's talk about the next chart you brought up, which is
Yeah.
something that I'm sure the Fed was thinking about yesterday, but didn't express it during the FOMC meeting. At least, no, he didn't.
Yes.
You're talking about this could be their worst nightmare with inflation. So explain to us what you mean by this.
Yeah, this is just looking at superimposing what's happened in the last few years over what happened in the 1960s and 1970s. Big outbreak of inflation. Inflation eased, the Fed cut rates, and then there was a second round of inflation that proved to be even more significant. And, Powell talked, and he's repeatedly said this. Well, we're facing this balancing act of if we move too aggressively too soon before the job is done on inflation, we run the risk of inflation returning. And conversely, if we drag our feet too long, we may cause the economy to slow more and unemployment ticked up. There's some very bright guys. There's a video that was done in the last week with Stanley Druckenmiller. I would advise everybody to listen to it. I mean, this guy's
Is that the
humility.
one where he's being interviewed by the Norgis?
Yes,
Yeah, okay.
yes,
I've got that on my to watch list. Yes.
yeah. I mean, what comes across for me, Blake, and I save that because I'm going to just keep watching that over time. This guy's been remarkably successful, but the degree of humility is amazing. His concern. And he says a number of times he doesn't have a high conviction level about the idea that inflation may come back. His conviction level was very, very high back in 2021 when the Fed was still maintaining easy monetary policy, and he was like, inflation is going to be a real problem. So, but his take is you've got the Fed easing at a time when gold is at an all-time, S&P is at an all-time high, the economy's growing at 2.8%, give or take a little bit, and the Fed's cutting rates because they think they're being too tight, that policy is still too restrictive. And he's saying, well, if you look at the markets, you don't see a whole lot of restrictiveness. And the other point he makes, and you and I have talked about this periodically, I've written about it, is the Fed is big on forward guidance. And they believe that forward guidance is a useful tool so that markets will know what they're going to do and that therefore leads to less volatility. And my take is, well, first of all, their forward guidance is wrong like two-thirds of the time. All
Right.
right. So it fails on that test. If you look at going back 20, 30 years, their forward guidance is bad. Um, but the point that he makes is that forward guidance kind of locks them into a path. because they've communicated it to this market. There's a natural reluctance then by the Fed to deviate what they've communicated. And there's a lag time then that gets built in. And as he noted, in 2021, inflation was going to be transitory. So they stuck to that messaging until it became amazingly, remarkably wrong. In November of 2021, inflation already was above 6%. And his point is that the Fed is dialed in now to be cutting rates next year because that's what their forward guidance is. And that if inflation starts to bubble up, that forward guidance may lead them to delay responding to that. I think it's a legitimate point. But just listening to this guy talk about some of the trades he's made in his career is really, really cool. So I would urge everyone to find that. Maybe you can post it on your website, Blake, because I just think that for anybody who's trading markets, this guy is a fount of wisdom.
Yeah, I'll try to actually add that to the comment section after this video is posted. So, all
Yeah,
right, well,
I've
let's
got the link. If you want, I'll send it to you. I have
very
it.
good. You can email Jim Welsh Macro at macrotides.com.
Yeah, and I'll send you
Or
that
no,
link.
Jim Welsh Macro at
Macro at
gmail.com.
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 Yep.
My bad.
Thanks.
Okay, well, okay, so let's talk about your next chart, which is borrowing rate 10.2%.
For small businesses. So my only point here is in the heat of everything that's going on, the assumption is that the economy is going to continue to be just fine, thank you very much, next year. And, my point here is that, wait a second, small businesses are still under the gun when you look at what their cost of borrowing is. Yes, it's come down a little bit, but relative to, most of the prior decade, it's still quite high. Small businesses create half the jobs in this country. The other thing that I'll note, and I didn't include it maybe next week, we talked about this earlier this year in terms of excess savings and how they've been spent down. I think that played into the election. There's a whole bunch of people who went through all their excess savings and they're feeling the bite of inflation very significantly. And that's why they voted the way they have and differently than maybe they have in the past. That's a problem. The seasonal adjustments on retail sales, on the employment numbers. We've talked about this. They've goosed the numbers. So we'll see if reality comes home to roost. Also, there was a New York Fed analysis on commercial real estate talking about extending and pretending of real estate loans. They're getting worse, not better, but banks have extended them, trying to not face the music. And that means there's a wall of maturity coming, Blake, that this New York Fed study points to. So my point is, in all this hoopla, in the short run, it will carry the day. But that doesn't mean some of the issues that I think are worth continuing to pay attention to may not make a difference as we go out a little bit further in time. So I just think, as always, you're a contrarian, I'm a contrarian. When everybody's
Wait,
jumping
wait,
up
wait, wait,
for
wait.
joy.
What are you talking about? You talking?
I'm sorry, I didn't mean to slander you.
Damn, damn. That's hurtful, Jim.
I know. I'm a man of mean language. My point is, I think one of the attributes of following markets is when everyone's getting excited or everyone's getting really depressed,
Hmm.
one has to kind of detach from that and just keep your eyes wide open for signs that maybe things are changing. That's
Sure.
all. To me, these are the things not to ignore anymore. Oh, we haven't had a recession, therefore none of this matters. I don't think that's the right policy or right approach.
Right. Okay. Well, Jim, let's continue on then. Let's
Yes.
talk about how you feel about this dollar.
Okay, so to me, the dollar pattern, the spike that we saw post-election, I think potentially is a wave five from the low. I turned bullish when the dollar was trading around 100. A couple months ago, most people were really negative, as you may remember. The dollar rallied more than I thought. I thought 102 and a half, maybe 103, and obviously we've gone further. But technically, this new high in the dollar, the RSI doesn't confirm it. And the thing I want to point out, and I'm going to find what I wrote back in 2016 and 17, Donald Trump does not believe in a strong dollar. He
Yeah,
believes in a weaker dollar.
that is true, supposedly. I mean,
Yep. No,
he's
it's not supposedly. It's what he has said, what he had believed. Now his logic is a weaker dollar makes it easier for U.S. companies to export goods,
right.
which strengthens the U.S. companies. So that's his mindset. How can we make America great again? And can we use tariffs to do that? Will we be willing to use a cheaper dollar? I believe so. Now, could there be other events going on in the world that, gives the dollar a lift irrespective of his viewpoint? Obviously, that's always possible. But his mindset is a weaker dollar. It's just a matter of time before those comments are remembered by people and then are repeated by either Trump himself or people in his administration. So to me, I just think people in all the hoopla have lost that point of view. Maybe they never really had it, that Trump believes a weaker dollar is to the benefit of the U.S.
So, with that being said, Jim, you technically, what do you see here? And you
Well, I
think,
see a divergence.
okay,
The 5 and 13 moving averages have yet to cross negatively, where the red line drops below the 13, the green line. But my take is I believe we're going to see a pullback in the dollar. And I when it comes, I think as we go into next year, um, I just think the odds are the dollar's going over below 100. Um, so that's my take.
all right. Well, that is your take, and I mean that's been your technical take for a long time. I don't want to say it's changed because it hasn't. But
No, no.
tell us a little bit about gold here because it
Well, I
looks
saw
like
this
you're
chart. A
calling the
fellow that
top.
a guy I follow on I still call it Twitter, so excuse me.
I call it
And
Twitter
I
too.
think someone else put this chart together, and then he highlighted it, and you can just see, hey, every 4 years, for whatever reason, gold has reached a top. So 2024, we know that sentiment is wildly bullish. Positioning for the last month or two has gotten very extreme, at least going back the last decade, of how many people are long gold in the futures market. So to me, this is just one of those things where it's like, all right, let's have a perspective, folks. Gold may indeed be going higher over the next 1 to 2 years, but that doesn't mean it can't have a 10% or more correction. And the next chart is, my take was we were going to see a new high after that little pullback, and we got it. And that we were going to see gold drop to 26 to 100 to 2650 and or 2625, pardon me. And we had a break of $141, a rebound to I think 2700 and change. Subtracting that 2708, 141 from that gets you 2567. So I think the dollar is going to, or pardon me, gold is going to correct more. Um, and if and when it gets below 2600, I think it will be time to revisit whether one wants to take a long position. But my view has been is that gold was in the process of making a high and that we would see a pullback to 2600. I would say that, what we've seen so far suggests that the pullback can go more than 2600, a real dip underneath.
Hmm. All right. Well, that would be well, everybody's been waiting for a pullback in gold. So maybe those I'm sure you're going to be looking over the next couple of weeks where are levels that you want to get long or might be some decent levels to get long.
Yeah, because I think again there will be a rebound no matter what. In other
Yeah.
words, even if gold is beginning a multi-week, multi-month correction, I don't believe it's just going to go straight down.
Sure.
Because a lot of people want to buy the dip. So that means we get a pullback, then I think there's going to be at a minimum a retracement rally. So let's say gold gets down to the 2570, just to make the numbers somewhat easy. That's $200. The odds are you'll see $100 rally, or more
Yeah.
off that trading low. And then it's decision time. Does it hit a higher or pardon me, a lower high? and be ready to roll over and have another leg down. That's my bias in terms of what's likely to happen. So
Sounds good.
it'll be a trading market, I think, for a little while.
Yeah, and I keep saying that about every asset class, but stocks seem to defy logic, but we're going to get to that momentarily.
In a minute. Yeah.
Yeah, let's talk about TLT because obviously we've seen bonds just continue to get demolished here.
Yeah, yeah. No, again, Wednesday morning was no fun. I had, subscribers who wrote to me, "What about TLT?" And I'm like, this is an emotional knee-jerk reaction because of the news. I think that at a minimum, if Treasury yields are going to just keep zooming over the next year or two, in part due to whatever policies Trump follows, in addition, maybe the economy doesn't ever slow down again, and the Fed not only doesn't cut rates next year, at some point in time, inflation does pick up, and all of a sudden, rate hikes are back on the table. I mean, that's the nightmare, if you will, for anybody in the treasury market. I just think, Blake, we're at a point where a retracement rally, TLT dropped $10. So, or pardon me, $12. $12. So a retracement rally, a 382 retracement gets it back up to 94 and change. 50% is about 95.60. Oh, look at 95.62 to me was way for a lesser degree. It needs to close above 93. If it can close above 93 over the next few weeks, then I think that 95, 96 target becomes somewhat realistic. If and when it gets there, that'll be, in my mind, like, okay, time to reassess. I just think near term, we're going to see treasury yields come down more than what they have. I mean, think about it from Wednesday morning. 10-year and 30-year treasury yields dropped by 21 basis points into this morning.
Yeah,
I mean, that's a pretty good move.
it is.
It got really oversold, very compressed. I think there's more upside, even if one wants to be bearish longer term. I think we're in store for a retracement rally.
Okay, well, let's talk a little bit about what's going to happen in the Russell. Let's get to the equity markets because Russell blew out. I mean, it's
It had an amazing
yeah.
day on Wednesday. But I was looking at the chart and I'm like, wow, that's interesting. Then I drew the trend line. I'm like, okay, this would be, as we were talking earlier, should we be prepared for a large decline in the market? No. But could you see a pullback in the Russell, for instance, back down towards 2,300? That's about a 3% or so pullback, 4%. Wouldn't be the end of the world. It'd be classic technical analysis, finally breaking out above 2,300, pull back to something close to it, and then maybe, starting another push higher. But near term, all I'm trying to say is I think the rubber band's gotten stretched on a number of the market averages. The Russell, and here's an example of that it's at a level where some resistance seems reasonable and just classic charting. Okay, pull back to 2,300 over the next couple of weeks or so. That would be pretty much normal behavior, even in an ongoing bull market.
Well, we're gonna have to actually see if that trend line holds, and maybe if we back up to the breakout point around 2,300, if it holds, that's going to be another question. But
Yeah,
it's like I look at these technical levels, and we just keep blowing by them like they're just speed bumps.
yeah.
Not even like good speed bumps either. So
Well, when we talked last week, what I pointed to was my expectation was we were going to see the S&P go to a new high. I did not in any way thought it would do it in such a dramatic fashion. I
yeah.
like a lot of people thought, hey, we're not going to know the results for at least a couple days and so on and so forth. Here too, you can see that the S&P is also approaching a potential resistance level just based on trend line analysis. All right. Um, so things like the 5 and 13-day moving averages are obviously the red lines above the green line. That implies that there's going to be any dip in the short run will be, I think, pretty shallow, Blake. just because of people wanting to buy any dip. But it doesn't preclude, something on the order of 2 to 3% pullback in the S&P. Even if one wants to be really bullish, that would be a normal uh, behavior. So I'm just basically saying, folks, I wouldn't be a buyer here. All right.
Yeah.
A week ago, when we were talking, I think the S&P is going to a new high, and it has. So now I think it's time to either lighten up or at least have some patience and wait for a pullback.
Well, and look, maybe we end up getting a blow off top in the market. There's so many people just getting in, and they want
Yeah.
in no matter what the cost, and they just want to be part of it. So maybe that
Yeah.
actually has to happen.
Yeah.
When's the last time you saw a blow off top, Jim?
I would say March of 2000, like in the NASDAQ stuff.
Yeah.
I mean, it was, from November of 1999 to March of 2000, it was extraordinary. I mean, I think the average was up over 40% in that 4 to 5 month window of time. So again, people need a reason to sell. The one thing that's just in the back of my mind, um, Israel very well may have not gone after Iran's nuclear facilities and obviously oil facilities. I mean, the reality is, I've done some research on this, Blake. Where did Hezbollah and Hamas and the Houthis get all the military stuff that they're using against Israel? They got it from Iran. Well, how did Iran pay for that? If you look at exports for Iran from 2020 to now, you'll see they went up from 700,000 barrels a day to over 2 million. So what happened? The Biden administration wanted to strike a nuclear deal with Iran, best intentions, and they got rid of a lot of sanctions. They unfroze $6 billion. So my point is, if I'm Israel and I look at, well, if we're going to go this far, what's the finish line? I think the finish line is going after the nuclear facilities in Iran. And then maybe you also look at some of the oil things because that oil revenue provided them 50 to 60 billion dollars of money they would not have had otherwise for the change in policy. And if you really want to cut the head off of the dragon, that's what you do. And so I think with Trump coming in, I think the risk of that has gone up. So,
There's just a short window of time that they could act.
well, they can act anytime they want. I mean, why? I mean, my point, they could act next week for all we
Yeah.
know.
I mean, no,
You know,
they have they want to do it before transition.
no, I think Trump is on board.
Yeah. Yeah.
Okay, that's my point, is that the Biden administration always, hey, we're 100% behind you, Israel, but we don't want you to do this. They've done that repeatedly, Blake. And again, the source of the money for all the weaponry that have been provided to those groups came from Iran oil money. Well, how'd they get that? The last year when Trump was in office, their exports were around 700,000 barrels a day. There have been over 2 million. How did that happen? And most of that oil is getting bought by China. So I just think if I'm Israel, you've come this far, stamping out Hezbollah and Hamas. Okay, that's a step in the right direction. But if you really want to finish the job, and I think, right or wrong, that Trump would be supportive of that, as opposed to the Biden administration, who has pursued, appeasement,
Yeah.
much like Obama did. So um, uh, again, I only bring this up is that, all right, let's get real here, folks. What could cause oil prices to go up significantly? What
Sure.
could upset the economic apple cart if something like that happened and all of a sudden oil's at $100 a barrel? That would happen again virtually overnight.
Yeah.
So those are the risks, and you can't predict it, but I think not to understand the history and how things have evolved over the last 4 or 5 years, and why they have evolved in part. I think a Trump coming into the White House, I think Netanyahu was pleased. He seemed to express it very genuinely,
Yeah.
you know?
And there's been a lot of discussions about what creates a top in the market is really a energy shock like that. So and
Yeah,
look, some of you at home may have some opinions, and if you do, jump down in the comments below and let Jim know how you feel about this. And
yeah.
Jim, matter of fact, I love your work. So how do people get your most recent technical review?
Jim Welsh Macro Gmail, I'll send it to you. And again, let me emphasize here, I'm not trying to pick sides in all this stuff, Blake. I'm trying to be objectively a realist. I'm not saying this is the right thing for Israel to do or not do or anything like that. It's just like, okay, let's just be objective about the pieces that are on the chessboard and how are they potentially going to react. If we don't do that, I think that you get even more blindsided by events when they take place.
All right,
So
Jim. Well,
I try to be as apolitical as possible in
right.
all this stuff. I just don't want
You
to
guys should hear
ruffle
him when
anybody's feathers,
you guys should hear him when we turn off the record button. Something else. Anyway, hey Jim, I want to thank you for being
Wait
here
a
with
second. I
us.
just want to check. Oh yeah, my legs just got chopped out from underneath me. Thank you.
Every week is such a pleasure for myself, and I know a lot of viewers. So thank you so much for
Thank you,
spending your
Blake.
time with us. And guys, if you like this video, make sure you give Jim a big thumbs up for being able to watch this with your Saturday morning coffee, and comment down below if you have any comments about the markets here. Jim, we'll see you next week. Thank you so much.
You're welcome, Blake. Always good to join you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.